Hey, this is Brant from Wolf on Wall Street Trade. It is Sunday, December 16th, 2018. I have a daily chart of the S&P 500 up, and I'm going to walk it back a little bit to show you where we started the week, picking up from last week's video. Still have this huge range in the S&P, about 200 points from about 2,600 down here to about 2,800 up there. I covered last week, I think traders look at this and they see a lot of different potential price patterns, like an inverse head and shoulders here that failed, a double bottom here that failed, a potential triple bottom here that failed, and walk it back to Monday. And let me just zoom in a little bit and I'll show you how Monday opened. So we opened here and ended with this hammer. It's a bullish hammer, a reversal candlestick or potential reversal. And I think a lot of technical traders saw this below this support here and thought maybe that's a bull trap. Didn't work out that way. Let's walk forward. Here's Tuesday, Wednesday, Thursday, Friday. So the S&P closed down about 1.25%. Low volatility week. VIX was down almost 7%. We also have a 50-day moving average here in yellow, a 200-day moving average in blue, and the 50-day is crossed below the 200-day, which is known as a death cross. I don't think it's particularly useful as far as trading, but if you take a quick look at a price chart, what it does tell you is that the 50-day average price is below the 200-day average price. Money is flowing out of the market. So let's take off these moving averages, put up some trend lines. And here's the S&P again, and this is that range I was talking about. So the S&P did close below that range and just a hair below 2,600, which I view as a psychological level. Matter of fact, on Friday in one of the intraday updates, I said, I think they're going to close it right here at 2,600. If we go back to what I've been talking about recently and in the last video, IWM or small caps have a different picture, and that's one of a descending triangle. And don't worry about the price pattern if you're not completely familiar with it. All it means is that this first rally was pretty decent, pretty strong. The second rally was weaker, and that forms this descending trend line here, and we have an area of support there that was broken on last week actually. So if we walk this back to Monday, something like a small hammer, and watch where it hits resistance here at that former trend line, at that former support, the current trend line, and turns down. One of the other things that's just been blowing my mind, and I've been talking about this I think since the second or third week of October when the market originally started to sell off, I was bringing up the potential of a double top in the market and how similar it looked to 2007, 2008 after the market made one record high, sold off a little more than 10%. Later that year it made a second record high in October and sold off again. So I'm going to show you that analog. It's hard to ignore. I'm going to do this with weekly charts of the S&P 500. So this is where we ended on the week. I'm going to walk this back to show you what I think is the analog. So let me just pull this back a little bit. So this is, let's see, I think that's the week of October 5th. Yeah. Okay. So we have this support, this trend up here, and the market broke down through that. So I'll show you what happened. We had basically a first leg down, a little bear flag, and a second leg down. On a weekly chart, it looks like this. The first leg down, the consolidation or bear flag, and then a second leg down. And that pretty much formed support, and thought, we're going to probably chop around for a little while. So if I go to the 2007 analog, here's the first high in May and the first sell-off. And here's the second record high in October. And here's, again, a weekly chart. Walk it forward. So first leg down, consolidation, second leg down to this perceived support in the low 1400 area. Now, I have the date down here, 2007, 2008, just for reference. I'm going to jump back to the current market, 2018. You can see down here. Let's walk it forward a couple weeks at a time. A rally, and the market gives it up and comes back down. So in 2007, 2008, rally, market gives it up and comes back down. And back to 2018, another rally attempt, and that just got wiped out. So back to 2007, 2008, rally attempt, got wiped out, right back down to support. And then if we look at what happened this week, broke down a little bit below that range of support here. And in small caps IWM, we definitely broke down, and we can walk forward here. And I showed you last weekend what happened next. So let me tell you, I have been bearish this market for the entire summer. Matter of fact, I've been short IWM. Let me pull up this daily chart of IWM. I've been short this whole thing. I took a little profit here, and I'm still short, and I added some QQQ short to add back a little bit of that position I took off here. I think I'm actually going to put in an order this next week or so to sell that position. It's actually long TZA, which is a 3 times short or 3 times bear small caps, but I am not covering it because I think the market's going higher. I'm going to be taking profits on it because I think the market is going to be heading lower. Last week I did cover what's going on with 52-week lows in the NYSE. Here's that chart, the S&P 500 this year, and I have a trend line at 2580. And what I was pointing out last week was the 52-week lows. Just envision these as selling pressure. So selling pressure rising. If you see this first sell-off in February and the market came back down and tested that level again, the 52-week lows contracted. Here they're rising, so I just don't see this support as holding. And matter of fact, it broke late last week. This is the same thing that happened, and I showed this in last week's video, the same thing that happened in that analog that is similar. And also, this past week, not only did IWM, just watch over here in the bottom right hand corner, try to rally and hit this former support, which is now resistance, and then turn down to a new 52-week low, but a lot of the sectors and a lot of the sub-industry groups that had rolled over first in late September, before the broader market, before the S&P, before the NASDAQ, a lot of those same sectors rolled over about the midpoint of last week. And I'll just zoom in a little bit here. A couple of those would be Dow Transports. They rolled over here last week. The regional banks, KRE, they rolled over here last week. And also retail. Here's XRT. That rolled over here last week. These are all the same sectors, or some of the same sectors, that came down before the broader market in September, October. They were showing relative weakness. If you go back and look at that analog from 2007, 2008, which I don't mean to offer as a roadmap, just showing that conditions as far as testing support were not good, and that support failed back then, and they're similar now. But if you look back then, all those same sectors were showing relative weakness. So Dow Transports relative to the industrials. I hope you can understand this chart. What it is the S&P 500 in candlesticks here, the red and green, and then I've got the Dow Transports relative strength or versus the Dow Industrials in white. So this is really just its relative strength, how the transports are performing against the industrials, which goes back to Dow theory. So you can see on the daily chart, when we got into late September, transports relative to industrials started really selling off, started declining. That was one of quite a few early warning signals, and that happened here in late January and early February too. That happened last week. And if we kind of go back and look at that analog I was talking about, here's the S&P 500 rolled back to 2007, 2008. There's the first high, the second high in October, and here's that first sell-off, and the market's testing this kind of low 1400, 1406 area. And watch what happens here. The transports relative to the industrials, you can just watch relative to this point, and same thing happens. They break down and they start leading the market lower, and just a bunch of sectors did that this past week. And that's kind of what we're looking for as far as what happened in the previous week, where the yield curve in some cases inverted and in all cases flattened sharply. And I don't think there's going to be imminent recession or anything like that, but it was just telling us that the bond market was marking down growth and inflation expectations, and that stocks were likely to follow. So all of that said, I do think that we have some more downside, but I am actually going to be putting in an order at a lower price, or actually at a higher price for my long positions in TZA and SQQ. And I'm going to be looking to take profits in the next week or two. I will give you guys those levels on the member side, and what I'll be looking at after that. It really depends on how the market acts and how this FOMC goes this Wednesday. But in the big picture of things, I think that we are going to see kind of a flush out, and I'm going to be taking profits on my shorts at that point, and then looking to move forward from there. So we will pick it up tomorrow. Have a great weekend.